Heads up, folks. Interest rates are falling. But as of September 23rd, 2024, you can still lock in a 6% or higher yield with a bond account at public.com. That's a pretty big deal because when rates drop, so can the interest you earn on your cash. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments. But you might want to act fast because your yield is not locked in until you invest. The good news? It only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account. Only at public.com. Brought to you by Public Investing. Member FINRA and SIPC. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures for more info.
This is an ad by BetterHelp. What's your perfect night? Is it curling up on the couch for a cozy, peaceful night in? Therapy can feel a bit like that. Your comfort place where you replenish your energy. With BetterHelp, get matched with a therapist based on your needs, entirely online. It's convenient and suited to your schedule. Find comfort this season with BetterHelp. Visit BetterHelp.com to learn more and save 10% off your first month. That's BetterHelp, HELP.com.
Hello, everyone, and welcome back to Always On Point with Kristen Ambos. Today, I'm so excited to have our guest here, Adam Schnable. He is, in full disclosure, not only a dear friend of mine, so he got conned into doing this with me, but he is also the WHEDA account executive for a lot of lenders here in Wisconsin, where we then bring to you all the details of how do you qualify for WHEDA. Just so you all know, WHEDA is our state grant program. So it stands for Wisconsin Housing Economic Development Association. Authority. Shoot. Well, it was close.
It was close.
So anyway, thank you to Adam for filling me in on this. There's a lot of acronyms in our industry.
There are. There's a ton.
Gotta give
there
it a
break.
manual. Right? So I'm so excited to have you here. Adam, tell us a little bit about your background at WHEDA and exactly what you do.
Yeah. So I've been in the industry now, 15 years.
Long time.
For my age, that's a long time. That's like just under half my lifetime. So that I'm alive. But at WHEDA, I am like Kristen said, the account executive. My territory is central and northern Wisconsin. Yep. So, but my history in this area of the state goes back quite some time. So I kind of gallivant over here once in a while.
Right.
I've been a lender and I've been the processor, been in title, and just have been involved with WHEDA from even the closing side to the origination side, the processing. And it made sense when I went over to WHEDA to now I work for WHEDA and versus just originating it.
Yes, it absolutely made sense. So in full disclosure, for all of you who maybe are aware, aren't aware, Adam and I used to work at another company together. Yep. And then Adam worked on my team with me. And that was in the height of the mortgage, industry a couple of years back. And then as we all know, rates shot up and positions started to diminish. And he looked at me and he's like, hey, I've got this opportunity to go work for WHEDA. And it was one that I knew was such a perfect fit for you. And selfishly, if you couldn't work for me, then I totally understood you going to work for WHEDA. But part of the reason why is because while you worked on our team, you were the one that brought WHEDA back to us.
I recall that, yeah.
And MCC and all the things. And because unfortunately, for a little while, WHEDA got a bad rap.
Yeah, it did have a bad, I full disclosure, I mean, my job is to really go out and put a lot of those things to rest and really bring light to what WHEDA is today. That's part of what we do as an account executive.
Right.
And put some of those misnomers behind us. And a lot of that comes from just, being in the industry forever and maybe they had issues, 30 years ago, but things have changed since then.
It's exactly what and now I'm a massive WHEDA advocate. Yes. So thank you so much because you completely turned my mindset on that. But it's very similar for people who are listening, whether you're a realtor or a consumer. It's the same thing with VA.
Yeah.
VA 30 years ago was something you never used as a lending benefit, and now it's phenomenal. So it just goes to show you that things can change for the better in loan programs. So don't ever just associate it. Look back into it and keep an open mind.
Things change all the time in this industry. It's
sure do.
We talk about all the,
yeah,
I mean, they're
do.
changing right now as we're recording this.
Yes.
I mean, it's constantly. And if you don't stay up on what's happening, you're already behind.
100%. You have to be so proactive in this industry. And we were even discussing it this morning when we met earlier on how that being proactive, if you're not proactive, you're 10 years behind in the blink of an eye.
Absolutely. I mean, technology changes constantly.
Yeah.
And it impacts our roles, me being on the, HFA side, you as a lender.
Yeah.
It's changing. And like you said, if you're not on top of what's going on, you are light years behind instantly.
You are. So speaking of that, that's a good segue into if you're not up to date on it. Mm-hmm. So we want to really bring you some of the reasons why WHEDA is worth looking at for clients, because I don't know that I think consumers are being more and more educated as they're looking into things, especially the younger generation.
Absolutely.
Where they can find stuff online. But the glorious part of WHEDA is it doesn't have to be a first-time home buyer, correct?
Correct.
So
it does not have to be a first-time home buyer. That's actually
amazing.
One of the misnomers or miscommunications, I guess you could say, is that you don't have to be that first-time home buyer.
No.
You can be that couple that's downsizing because their kids are gone, or maybe you're increasing the size, or you have a growing family and you just don't have that down payment, or maybe you have the down payment and you're really just using it for the program benefits. There's multiple scenarios I could come up with where WHEDA would be the option for borrowers.
100%. So some of those, and I think it's important to talk about the misnomers today.
Yes.
On
100%.
it, because then you educate yourself on understanding that. So not only is it almost a 0.5%, if not more, better interest rate for a lot of people.
100%.
It also, we can use it for VA.
Yeah, so you can use it. So there's 3 ways borrowers can really benefit from a reduced interest rate. So it's on our conventional program right now.
Right.
And hopefully we can make some changes to that in the future. But for right now, conventional is the space that borrowers can get the reduced rate. There's 3 ways. Being a first-time home buyer, which is probably the most thought of reason why somebody would use WHEDA, even though we do more than just first-time home buyer. That's really a misnomer.
Yep.
That we only do first-time home buyer, and that's not true.
Not true.
The second way borrowers can receive that reduced interest rate is being an eligible veteran.
Yeah.
So it's not a VA program, which means you're not using a VA appraisal. There's no funding fee. There's none of those VA requirements.
Got it.
They just need to have a DD 214, which to those that are listening, this is your discharge paperwork.
Yeah.
And it needs to show that you are honorably discharged. So pretty simple to meet.
That's huge.
Yeah.
Absolutely huge.
And they still get 100% financing,
Yep.
between our down payment assistance and the conventional side of things. So they're still being honored for being a veteran by getting a veteran benefit.
Right.
But they're getting conventional financing.
So it's the best of both worlds.
It's the best
a lot
of
of
both. Yeah.
a lot of people would say right now.
100%.
Okay.
And
love it.
The third way is by purchasing in a designated target area. So
Yep.
these are federally and state designated target areas.
Yes.
There's 15 whole counties in the state of Wisconsin. So anywhere they buy in those whole counties, they can be eligible to receive the reduced interest rate, whether they're a first-time home buyer or not.
So that's huge. So for example, one of the counties I believe is a whole county.
Oconto.
Is Oconto.
Yep.
So that's right in our neck of the woods. So you have an Oconto County. You don't have to be a first-time home buyer. You doesn't matter where the boundaries lie as far as like a USDA loan, for instance, where you have to buy in a certain area, and you get the reduced interest rate.
Get the reduced interest rate. And
I
you
mean,
just purchase in that
keep
county.
giving me all this good information, Adam. I love
Purchase in the county. Not only
Yeah.
do they get the reduced interest rate, they get expanded income limits. Being that we're a housing authority, we have to follow rules, which our rules in my world is state statutes. So these are kind of the law that we have to follow.
it. Okay.
And one of those is household compliance income limits.
Yep, absolutely.
So when you're working with the normal, typical first-time home buyer, you have that reduced income limit, which it's to me really conservative. I mean, when we're talking about it, it's typically between 80 to 140% AMI.
Area median income for those of you that don't know.
Sorry for the acronym.
No, that's okay.
And those limits are truly amazing. They're conservative. A lot of people fall in those income limits, but we're looking at that household income limit. So
right.
If they're in that first-time home buyer, they're really restricted to that. With target area purchasers, they get that expanded income limit. So it's easier to qualify.
So to give you guys all who are listening right now an example of that, I had a buyer this weekend that we were looking at. She was single and could make up to $104,000 a year annually and still qualify. That's huge. Oh, yeah. And then in some of those target areas that have the expanded income limits for more. Yeah, for a household of I think like 1 to 4, it's somewhere between $120,000 and $36,000 a year income.
Depending on the county, depending on the program, 100%.
And that's the thing where I think it is mind blowing that people think, oh, well, I make more than that, but do you?
Right.
Maybe for some loan programs. And so it's really important that you work with a lender who has all of these loan programs for you, because there might be a lender out there that denies you, but that's simply because they don't work with WHEDA.
Right.
And then now all of a sudden we can approve you because we do work with WHEDA and we have no overlays. We just go based off of your guidelines.
Yeah. And that's a good point that you make, because we work with 165 plus lenders throughout the state. So these are lenders that we require they have a brick and mortar within the state. So yes, they all have a physical location.
Yep.
But they're all banks, credit unions, mortgage banks. I mean, because we have all of these relationships, an experience that the borrower will vary depending on what lender they use. Because we allow lenders to put their own overlays. So just because, a borrower goes to, ABC Credit Union, they may be told that the minimum credit score, say, is 650. If they go to ABC Mortgage Bank, they may be told that the minimum credit score is 620.
Right.
So it could vary. And that's where some of the misconception, I think, comes into play, is that because we allow lenders to have some flexibility, for their risk tolerance.
Yep.
That's where some of those misconceptions come from. And is it unfortunate sometimes, but we're giving our lenders that flexibility to accept the risk that they want.
Yeah. And I think the bottom line to that is just don't always stop at one person because they told you no. Get that second opinion.
Yeah.
Because that second opinion can really make a difference on your qualifying level. The other part that we were speaking with, as we were getting ready for today, the fact that if you can get a lower interest rate, you can get reduced private mortgage insurance.
Yep.
That increases your ability to buy. And now maybe for the same payment, you can buy a 225 house instead of a 200.
Yeah.
That just gives you an example. But now it opened up your doors of what you're looking at with your realtor to find out exactly what you can afford. And maybe you can buy just a slightly nicer house and the payment is no different for you.
And you touched on some benefits there. And I think it's important,
yes.
for consumers to, I will admit, I'll be maybe the first or second to admit that when we take part of a program, I kind of want to know, what are the benefits of doing this?
Oh, yeah.
No matter what you're doing in your life, the benefits for WHEDA really are, to me, almost endless.
Yes.
Some of the biggest things, reduced interest rate, which affects affordability. Affordability is key for WHEDA. Reduced mortgage insurance, like you just mentioned, another huge benefit. Reducing that mortgage insurance almost in half, from 35% to 18%, is huge.
It's huge. So that might be, instead of paying $60, $70 a month for insurance, mortgage insurance, or more, you're paying $30, $35 a month. Now that's a whole, and to put it into layman's terms, every time you go up about $10,000 in purchase price, it costs you about $50 a month, just 50. So, but what that means is now all of a sudden you instantly went, just on the private mortgage insurance savings, up $10,000 in purchase price.
Yeah, exactly.
That's incredible.
you have that wiggle room in there
Yep.
for negotiating on the
Absolutely.
on the purchase side.
Yep.
Some of the other benefits too is when it comes to the servicing. I mean, really, you've been doing WHEDA now since I've
Yes.
threw you back into the WHEDA pool.
Yeah, you did.
The servicing is completely 100% by WHEDA.
Right.
So when they call, they're going to call and get somebody from our main office in Madison.
Yep.
And we don't sell that on to another larger bank, like some other authorities may do. We keep it. And
Yeah.
that's one of the consistencies as a homeowner. I mean, I remember talking to other buyers, even when I was lending, like, well, now, somebody, so-and-so has my loan. And then, 30 days later, they get a letter that it's being sold again. And they won't have to worry about that with WHEDA.
Yeah.
They know that they can always make their payments to WHEDA.
Your payment's going to WHEDA. WHEDA is your servicer for the full 30 years or until you pay it off, any of that. So that's really important because a lot of people, especially in these smaller communities, really still love that hometown feel.
Oh,
and this is
100%.
all right in Wisconsin.
All right in Wisconsin. And I'm very much a proponent to, money, spent in Wisconsin stays in Wisconsin.
Yep. I agree.
This is 100%.
Yeah.
I mean, we just self-funded. So this continuing to lend is what keeps that ball rolling.
Yeah. And now for somebody out there, maybe a real estate agent or a consumer that doesn't know, does WHEDA ever run out of funds?
So like we're self-funded. I mean, we get funding sources from, we do bond lending. We obviously through servicing are able to
Make some money back.
Make
Yep.
some money back. We do have some connections where what we call a quasi government agency, we're connected a little bit, but yeah, I don't remember the last time we ran out of funds.
Yeah.
So
I don't either. I don't think it's possible.
I don't think it's possible at this point. With that being said, do we have programs that are specific for certain things? Absolutely. Do they have their own funding limits? 100%.
Yeah.
Those are separate. But as for general financing, that's just that bucket of goodness. I mean,
Yeah. What is the max, or I should not, maybe not the max, but what's the type of property that you can buy with WHEDA?
yeah, so it does vary on the program because we do offer conventional and FHA financing.
Yep.
For conventional, these programs, I mean, it's amazing. It blows my mind still to this day.
Yeah.
Single family, obviously, any single family residence, that's typical that you'd think of.
Yep.
Condos, as long as they're warrantable by Fannie Mae. Manufactured homes,
Yes.
which is huge in
Huge.
Wisconsin, as long as they're real property per se.
Yep.
Which we kind of chatted a little bit before, but working with a reliable title company to help with that is crucial.
Yep.
And then the other one is multi-family property.
This is the one that blows my mind.
So anything from a duplex to a quadplex.
Yes.
Which is insane. A first-time home buyer could purchase a quadplex, get their home buyer education, and then get their landlord education and purchase a quadplex property, reside in one of the units because it's required. They
Yep.
have to be owner occupied.
Yes. Thank you.
Sorry, I was going to say owner occupied. And then rent out the other 3 units. And those other 3 units are making their mortgage payment.
So they can buy it, no money down.
Well, there's an investment they have.
Okay.
3%.
They have to have
Typically, it's their
3%.
earnest money.
Sure, absolutely. So if they put down their earnest money, they can turn around and get that back towards their down payment.
Well,
That's typically how earnest money works. Or
yeah.
like it's a credit to what they're bringing in
So
at closing.
It's going to be a credit to what they bring in at closing. They just have to have that 3% investment, which it's very easy to have a 3% investment nowadays.
Yeah. So in layman's terms, because I always like to break it down for the
Yeah,
consumer. So let's say they get really lucky and they can buy $100,000 fourplex.
Pipe
I mean,
dream.
we know this is a pipe dream, but go with me on this one.
Yeah.
Easy math. So you have a $100,000 property. You need 3% down. That's
$3,000.
That's $3,000 out of your pocket
Yeah.
that you need to put down to buy an owner-occupied 4-unit property,
Yes.
rent the other 3 units out.
And they make your mortgage payment.
They make my mortgage payment. Do I owe WHEDA any money back out of that?
I mean, your monthly payment.
Okay, just my monthly payment. Okay, I can handle that. No,
I mean,
I don't owe
and
you anything else.
They can still get their down payment assistance from us as well. So they just have to have that 3% investment. So if
That's incredible, you guys. My mind is blown thinking about this.
yeah, so let's really dissect this.
Yeah.
I think it's important. I mean, because house hacking is a thing.
Yep.
And
it's real.
It's very popular now.
Yep.
I mean, we were just chatting about this around 2008 to 2010. It kind of went away, and now it's starting to come out again. But
so many young consumers are interested in investing in real estate. They're just not sure where to start.
I feel like my age group kind of missed the ball on this.
Yes, I agree.
I just kind of fell out of that.
I'm a little older than him. But I was probably the tail end of where people really were invested in real estate. Like it's still a passion of mine, but I agree with you. My brother's age group and a little younger were really not interested in real estate at all. And now we're getting it back around.
Again,
so,
So they can, with that, back to how this works, is, if I'm buying a quadplex, I have to occupy at least one unit. Perfect. Yes, pipe dream, $100,000 purchase price. I, as a buyer, have to have $3,000 invested into the transaction.
Yep.
Now, that can be met multiple ways. Earnest money, my upfront application fee, if there is one, my homeowner's insurance, if I'm paying that upfront, I can count that towards that. Any multiple things that they're paying
out of pocket.
Can go towards that 3%.
Okay.
Now I can take advantage of down payment assistance with WHEDA, and it could be the Easy Close, which is one of our most popular. I mean, between the two, probably the most popular.
Yep.
Where I could get up to 6% of the purchase price. So I have a $3,000 investment, but now I'm getting an additional $6,000 from WHEDA's down payment assistance to put towards the transaction.
Yep. And remember, this is just based on $100,000.
This is just based on $100,000.
So if you're looking at 200, double it.
Yeah. Or 300 to even.
Yeah.
Because let's be real. A quadplex is probably
fair enough.
3 to 4.
Yes.
Yeah. So getting those funds, I can use that towards down payment. I can use it towards other closing costs.
Right.
And that way, all I'm really looking at is my 3% investment into the transaction.
Yeah.
Now, I can also then get cash back at closing as long as I'm not getting back my 3% investment. So say my earnest money was $6,000 for my $100,000 purchase.
Yep.
I can get $3,000 back.
3,000 of that back as long as you have 3,000 in.
Yeah, as long as that works out, I could get up to that $3,000 back. Yeah.
I mean, who doesn't want to do that? I want to be a first-time home buyer.
I wish I could
go in there.
Yeah.
And again, listen to me. I just said it. I want to be a first-time home buyer doing that again, but you don't have to be a first-time home buyer.
Yeah, you don't have to be a first-time home buyer.
So I know better, but it's easy just to immediately say first-time home buyers. So we all have to get it out of our minds that this is not for first-time home buyers.
Yeah, it's not for first-time home buyer. It's for any Wisconsinite that is eligible.
Yep.
So really, when our lenders are looking at the WHEDA program, they're looking at eligibility for the program and then qualifying.
Yeah.
So it's two different things in the WHEDA world. They're looking at how is my borrower eligible for the program? And that's based on what we talked about a little bit before, the compliance income.
Yep.
And then from there, they're determining the qualification. So that's really when we talk about those two things is, eligibility and qualifying is two different things to us.
Yeah. The other thing I want to note too that I think is so important with this is if I have a 650 credit score, I'm not hit any harder on my interest rate than if I had a 750 credit score.
Yeah. So we have, I'm going to use an acronym, but I'll explain it for everyone, but we have no LLPAs, so low level pricing adjustments. So this means that, if I'm coming in with a 650 credit score, you're coming in with an 800 credit score, we're both using the same lender. We're both getting WHEDA programs. We're both getting the same interest rate as long as it hadn't adjusted between, the days we applied. And
right.
But we're not penalizing borrowers for having a lower credit score. Or, there can be a LLPA for DTIs. I mean,
yeah. So your LLPAs are basically saying, okay, you're a higher risk borrower.
Yep.
So we're going to charge you a little bit more in interest, whether that be 0.25% more, 0.5% more.
Which doesn't make sense to me when we're talking about, I have a hard time conceptualizing that. Why are we penalizing?
We're penalizing people that, in the interest rate. So your basic conforming loans will do that. WHEDA will not.
Right.
So again, you could have a 5%, 10% down payment and still maybe have a little bit of a lower credit score, but not be penalized on your interest rate. So another benefit as to why you should be looking at this program.
Yeah.
It's not just because you have no money down.
You kind of led into the down payment part. I mean, even if we have a first-time home buyer I just did it myself.
Yes, it's so easy to just assume that. But I'm buying a house with WHEDA.
Yeah, buying a house with WHEDA. Even if they have a large gift or they're selling and they have their 20 plus down, that's perfectly fine. If they're eligible, they can put as much down as they can afford. They don't have to take the down payment assistance, or it's not just for borrowers that need down payment assistance.
It's
like any
Wisconsinite.
Yeah.
That's how we need to start addressing it. This is a Wisconsinite program. For those of you out there that are listening, it might be in other states. There is one in Illinois. There is one in Indiana. Most states have a program like this. And you can also use it with some other down payment assistance programs locally, such as like a Neighbor Works or an Appleton Housing Authority.
Municipalities have their own programs.
Yeah. So the main key here is working with a lender who has the program, who understands the program, and truly wants to do what's right by you as the consumer.
Right.
And not just putting you into a program that they might make a little bit more money on, but actually putting you in the right program for you and your financial future.
The lender also needs to know where the resources are.
Yep.
Because there will be questions.
Absolutely.
And you touched on it before. People now have knowledge on their phones right in front of them 24/7. They're coming in with educated questions.
They are.
If you're not ready for them, they're going on to the next person.
They are.
So knowing where those resources are is crucial. So being that there are several account executives throughout the state, our lending partners have direct access to us.
Yes.
To get information.
Right. So there's no question that the lender can't answer. Maybe they say, you know what, let me call my WHEDA rep and I'll be right back with you. But we have direct access to that. We can do that. So, and always thank you so much for being available.
Oh, yeah.
Adam's amazing. There are times where I'm doing a pre-approval on a Saturday and I have a question on something and he'll answer me like that. So
I try to.
Like all of us in the mortgage world and real estate world, does work on nights and weekends behind the scenes, but it's always awesome. Well, Adam, I can't thank you. Yeah. Your wealth of knowledge in this program is great, and I'm sure we will have you back again to break down even more of it.
No problem. I look forward to another edition of Breaking Down WHEDA with you.
Awesome. Thank you so much. For those of you who are looking for more information, please reach out. I'd love to give you the scope of what WHEDA is and how we can hopefully help you get into a WHEDA program. So for today, we will sign off here with Adam Schnable from WHEDA.
Listen up, folks. Time could be running out to lock in a historic yield at Public.com. As of September 23rd, 2024, you can lock in a 6% or higher yield with a bond account. But here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment-grade bonds, you might want to act fast. The good news? It only takes a couple of minutes to sign up at Public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at Public.com. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit Public.com/disclosures for more info.
It is Ryan here, and I have a question for you. What do you do when you win? Like, are you a fist pumper, a woohooer, a hand clapper, a high fiver? If you want to hone in on those winning moves, check out Chumba Casino. Choose from hundreds of social casino-style games for your chance to redeem serious cash prizes. There are new game releases weekly, plus free daily bonuses. So don't wait. Start having the most fun ever at ChumbaCasino.com.
Sponsored by Chumba Casino. No purchase necessary. VGW Group. Void where prohibited by law. 18+. Terms and conditions apply.